Hello, everyone, and welcome to our podcast. We'll dive into the latest developments in the world of money and banking. I'm Phil Gallagher, here with RJ Sahni. RJ, thanks for coming in, and could you give the listeners a quick recap of what you want to talk about today?
Yeah, of course. Today we're focusing on a major event that recently impacted the financial world. The Federal Reserve's decision to cut interest rates by 50 basis points last month. When I first came across this news, I didn't really understand what it meant in terms of macroeconomic outcomes. But since I'm taking money in banking along with intermediate macroeconomics, I thought that this would be a good time to dig deeper into the implications and objectives of monetary policy. In this podcast, we'll explore why the Fed made this decision, how it connects to key concepts in monetary policy, and what it means for financial markets and the broader economy.
Awesome. And just to give everyone tuning in right now a quick recap, on September 18th, 2024, the Fed announced that it was lowering the federal funds target range to, I think it was 4.75 to 5%.
Yep. And that was the first time in 4 years that they've cut rates.
True. I mean, after months of steady inflation decline, and with August marking inflation rate landing between 2.5% after a 9.1 peak in June of 2022, I think the Fed decided the time was right to just shift gears. They explained that with inflation moving towards its 2% target, that this was a good time to shift away from raising rates and move into a period of easing monetary policy. I mean, I can't say that I exactly saw it coming, but RJ, did you predict this?
Yeah, most definitely, Phil. I mean, hindsight is 20/20, but I can break it down like this. There was always going to be some debate over the size of the cut, and while many people expected it to be smaller, I think the more aggressive implementation of a 50-point cut was overall a good call. We saw an immediate impact on markets and an increase in consumer confidence that caused investors to rally behind the stock market. To me, it's clear that the markets appreciated the Fed's decisiveness.
Well put. But let's take a step back for a moment and try and connect this with the broader concept of monetary policy with a quick explanation for the listeners. It is well known that the Fed used monetary policy to keep a hold on economic stability by controlling two main aspects: the money supply and interest rates. In class, we learned that one of the functions of a modern central bank is to act as the quote-unquote government's bank in order to ensure steady economic growth and low inflation.
Yeah, exactly. And in this particular instance, the Fed is leveraging interest rates to control the availability of money and credit. Lowering the federal funds rate made borrowing more appealing in an aim to stimulate the economy and encourage both spending and investment. This is a clear example of expansionary monetary policy where the Fed is trying to boost economic activity during a period of low inflation.
I would also like to point out some impacts to the bond market. While it's historically true that bond yields can be expected to drop after a rate cut, which can push investors towards stocks, alternative investments, or generally other high-yield assets, well, this is exactly what we saw. And as I think I mentioned earlier, there was an immediate response within the stock market, and we saw, at least periodically, new highs for indexes such as the Dow Jones and the S&P 500. Unfortunately, however, this period of upturn was short-lived as more long-term questions regarding the potential overheating of the economy came into play.
Yeah, I mean, taking into account what you just highlighted and looking at the future impacts of these rate cuts, I think it might be safe to say that we can expect an increase in borrowing and spending, and then obviously logically speaking, economic growth as well. Personally, I'm excited to see how this plays out. I mean, mortgage rates have already started to decline, and while it is true that interest rates are still higher than they were 15 years ago, discouraging individuals with pre-existing fixed-rate mortgages to sell, causing a shortage in the housing market. But regardless, this is a step in the right direction.
Yeah, I couldn't agree more. And, the Fed Chair Powell signals more rate cuts are likely, but their timing and size is going to depend on more economic data. And with the Fed taking a more cautious and, meeting by meeting approach, that takes us into more of a long-term perspective, where if the Fed cuts interest rates too aggressively, it could overstimulate the economy and lead to, asset bubbles and issues in sectors, like you just said, such as real estate. There's also the risk that as interest rates shift lower, the dollar could depreciate, resulting in increased capital outflows and exchange volatility. Especially with the Fed announcing more rate cuts to come, the economic risk of overheating is, I think it's in the back of everyone's mind.
Yeah, well, I mean, with that being said, in class we've learned that the central banks work to reduce the volatility of economics and the financial systems by pursuing stable interest rates, amongst other things like simple markets, inflation, etc. And while there are risks, I think it's important to remember that the Fed has the tools and experience to adjust its course if needed. And the good thing is about our system, it's not set in stone. Policies can be adjusted along the way to ensure the economy stays on track. And if this is done in the right way, these rate cuts could lay the groundwork for a more sustainable growth in the coming years and bringing down inflation without harming employment or market momentum. There's every reason to believe that with careful monitoring, we could definitely navigate this period successfully and emerge stronger.
Yeah. Well, I think that's all the time we have for today. RJ, thank you so much for coming in, and we hope to have you on again soon.
Thank you.